SB Talks. Today is Wednesday, April 3rd, and I am joined as ever by our Chief Investment Officer, Nick Ryder. Today, Nick and I will be discussing the latest March RBA minutes, the dampening rate cut urgency in the US, and resurging manufacturing globally. Welcome, Nick.
Thank you, Vinny.
Yesterday saw the release of the March minutes of the Reserve Bank meeting. For the first time in this cycle, they didn't canvass the room for a rate increase. What's your take on what was revealed within the minutes?
Yeah, it was the first meeting since April 2022 where they didn't actively discuss a rate hike. I think what they were saying was that they're firstly they have this liaison program with businesses, and that from their liaison program they were saying that wage growth may have peaked, so that's giving them a little bit more confidence that things are becoming risks are more even, as they said in the minutes.
Do you mind unpacking that one a little bit further? How are they gathering that data to make that decision?
Well, they talk to businesses. So they have this liaison program with businesses, and I guess they get feedback from that program. So people at the RBA talk to different businesses and they ask them, I guess, a bunch of questions. And they don't publish the results of that, but they do talk about it from time to time.
So the feedback there is saying wage pressures are easing somewhat.
Yeah.
The level of wage increases that need to come are maybe not as great as what had been before.
Yeah, I think they're probably saying that there's been obviously a degree of catch-up that had to happen over the last couple of years as people's real wages kind of fell behind, and certainly there's pockets, like childcare and aged care, etc., that have seen sort of big wage increases, and they probably needed those. But I think more broadly, they're getting more confident that, wages growth, I think, is 4.1% currently, and they don't see that necessarily going up from there. So it gives them more confidence that that wage price spiral that we've talked about before is easing, and that gives them probably more confident that the services inflation will start to kind of come down a bit.
Which had been the more lingering, sticky part of the inflation picture. Anything else in there catching your attention?
Yeah, so they said leaving the cash rate unchanged at this meeting was the best way to achieve a return to target. Reinforcing that view that if they just keep rates at this level, then hopefully with the passage of time, inflation will start to come down back towards their target rate over the next 12 to 18 months, which is what they're forecasting. I think the other thing that came out of this, and it's more there's a couple of other things. One is that they said that they want to preserve the gains in the labour market. So they still describe the labour market as tight, but they do see it easing, or pressures easing. So they think that full employment is probably kind of in that mid-4s, and I think we bounced back down to 3.7 with the latest reading. So they think that the pressures are easing in the labour market, although they still describe it as tight. So they want to hold on to the wage
sounds like
gains.
A delicate balance there.
It is.
They're trying to probably release a little bit of pressure in the labour market, but they don't want to create a significant impact to employment levels. So
So that is basically steady as she goes. I think the other thing that was interesting, and this is kind of a bit technical, comes down to financial system plumbing. They're going to do a review and change the way they manage the cash rate, the overnight cash rate. They're moving from a system of scarce reserves to ample reserves.
Okay, unpack that for us.
Well, I won't pretend to understand the plumbing of the financial system. But the way it works at the moment is they pay interest on exchange settlement balances that the banks have to keep, the reserves that the banks have to keep at the RBA at the cash rate, and then if the kind of cash rate varies, then they do the step into the market to provide liquidity or suck up liquidity.
Yeah.
The way they're going to run that, and it's not finalised yet, there's going to be a consultation period with the banks, is to run these sort of auctions where they provide liquidity. And as I understand it, the new system for setting the overnight cash rate will be similar to what the ECB, Bank of England, and Sweden's Riksbank currently does. So it's tried and tested.
What are the advantages? Can I ask?
The benefits for them is that it reduces liquidity and forecasting risks inherent in the old system. So I think they had to sort of forecast how much liquidity the banks were going to need and then kind of
provide that liquidity.
Yeah, then provide that liquidity. Whereas this, they just run these regular auctions, and I guess the market determines how much
you need the liquidity, you pay for it.
That's right. Yeah. So, it's interesting. As I said, it's quite technical. It comes down to the financial system plumbing. And I think, given how much reserves that kind of got pumped into the system during COVID, and that's now gradually being sucked out, they want to make sure that there's enough liquidity in the system as those reserves drain down. So I think, that's just an interesting thing that came out of the minutes.
Now, from the last RBA rate decision, I guess something was made of the fact that they'd moved from sort of that tightening bias to sort of more of a neutral, even edging to sort of rate cutting position. But probably clearly not necessarily in any great hurry to do that, and the minutes probably just reinforced that as well, the data dependency element. Also reinforcing that is probably some strength or rebounding strength in the housing market. So we saw, I think, last month, CoreLogic house prices up 0.6% before the seasonal adjustment. Probably another reason for a tone of caution from the RBA.
Yeah, the RBA doesn't really like to weigh in too much on the housing market. Occasionally they make comments about it being, maybe unhelpful to what they're trying to achieve. And I can't remember if there was anything in the current minutes about house prices, but certainly, another 0.6% print for March after the same in February. Adjusting for sort of seasonal factors, it was 0.3. Which is actually the softest since January 2023. So obviously we get a lot of sort of pent-up demand and house price go up quite a lot. The early part of the year is sort of people get back from holidays. So adjusting for that, it was maybe a bit slower. But the year-on-year number of 9.7 just shows, a
very significant rebound.
It's quite significant. Yeah. Interestingly, Sydney and Melbourne was a bit more subdued. The other capitals was where a lot of the strength was seen. A couple of other things from the report was interesting. The sales volumes, which had been pretty soft over the last few years, as we went through that rate rise environment, have rebounded. So about 4% higher than the kind of decade-long average for this time of year. So
supply coming back to the market after a period of very limited supply, potentially.
Yeah. So despite strong rises, there's good supply. So I think that's interesting. The other thing is just rent. So CoreLogic also tracks rents, and that was the strongest quarterly rise in rents since May 2022, 2.8% for the quarter. So, playing into that story of the housing market just still being really tight for both prices and rents.
That immigration impact of supply of people coming in and the ability to just house them is a real problem.
Yeah. The RBA also, sort of in a related thing, they published their financial stability review in the last couple of weeks, and still saying that generally, the financial system is strong, although there are certain pockets of borrowers that are facing stress. It's not a problem, and the banks, actually, their loan losses, they're revising them down, or their projection for them. So, that plays into, I guess, the strength of the housing market kind of helps some of those weaker borrowers, sell if they need to.
And less likely for impairment on loans then.
Yeah, absolutely.
Now, offshore, we've had a little bit of the old story. The good news is bad news out of the United States. We've had some positive US economic data across a couple of points. Plus, Chairman Powell to say dampening excitement in terms of the urgency of rate cuts. Their combination of those factors has seen the market just take a slight breather.
Yeah, so we got the Fed's preferred inflation measure, the core PCE, which is personal consumption expenditures. That was in line with expectations. It rose 0.3% or 2.8 year on year, so bang in line with expectations. Actually, to two decimal places, it was 0.26. So that was actually pretty good. And the measure of services inflation excluding housing, I think we've spoken about this previously. This is the one that's sort of the Fed's focused on, was 0.18.
Right.
So Chair Powell said that it was in line with what we want to see. If we get more good readings like the ones we've had last year, that will be encouraging. but the strong growth in the economy means there's no hurry to cut rates. So I think those comments, no need to hurry to cut rates, has seen the market kind of, take a little bit of a step back.
Recalibrate again.
Yeah.
I think if we go back to, we talked about this in the last podcast, late last year, probably maybe a hope more than an expectation that we might see even as many as 6 rate cuts out of the US. Now that has really dialed back from there.
Yeah, so we're standing today at 67 basis points price, so that's slightly less than 3.
Yep.
Now the Fed's own dot plots, which I think we wrote about in SB News, is still for 3 rate cuts this year. The median expectation from participants on the FOMC is for 3. So we're at less than that from the market. So yeah, I think we've really seen that wind back. And, it's interesting. Some people saying, the strength of the US economy could be such that we might get 0 cuts this year. That is certainly a risk if things held up. And we got the job openings data last night showing still quite healthy level of job openings at 8.8 million. So, it's still quite a healthy labour market. Yeah, inflation's coming down, but broadly it's a strong economy. We also had the.
Can I pause just one
Sure.
second and just ask? Can I get your opinion, your take on where we are with the likelihood, timing, and level of rate cuts? Worth reiterating for the listeners, you've been in the more cautious camp. You had not expected probably aggressive rate cutting, and you expected it was probably coming in the later part of 2024 globally, and certainly, if anything, late 2024 domestically. Has your picture changed, or is more that the consensus view is probably more in line, or is your view also pushed back?
I still kind of think June, July would be
cut 1 US on the US.
Yeah, I still think that's likely, although the market's only got a sort of 60-70% chance of a rate cut in June. It's got a fully priced cut by July. So the market's still in that June-July camp, which I think's about right. If that core PCE number, which I discussed, was 0.26 last month, if that continues to print at 0.2 over the next few months, then we'll have annual inflation come down to 2.5% in April and 2.4% in May. And that's not far off the Fed's 2% target. So I would think if we got that in April, May, then the Fed would be justified in cutting rates.
They would feel comfortable and confident enough to make that
in
first
June or
move.
July. Yeah. So a lot depends on the data between now and then, but if everything keeps happening, that services ex housing inflation continues to moderate, then I think June, July still looks like where the money should be. Yeah.
And then you think another 1, maybe 2 in the later part of the year.
Yeah, I think they'll proceed cautiously.
Obviously got a US election in there.
Yeah. They try not to take that into account, but it
does make it a slightly more delicate decision.
Yeah, and they would probably want to move ahead of that, so that's in November, so they would probably want to start cutting before then, so as not to be seen to be politicised.
And could I ask you domestically? So we spoke just a few moments ago regarding the RBA minutes and the expectation if we did see cuts that would be really at the back end of the year. Has your view changed much there?
Yeah, so a lot of economists had gone for sort of August, September. We've seen probably a little bit less around that. It's really now the first cut's not fully priced till November.
Right.
And just 33 basis points by December. So I think that probably looks, it's hard to know. These things fluctuate day by day, but that sort of appears right. I mean, there might even be arguments that they could bring that forward.
Data dependent?
Data dependent, yeah absolutely. And we know, the labour market's sort of gradually rebalancing. The monthly inflation numbers have been reasonably good. If they see maybe some evidence that wages aren't going up, and we know that their consumers been exceptionally weak, retail spending's been weak, so they might have an argument to cut a little sooner.
Yeah. Okay, we've spoken on the podcast previously regarding potential rebound in manufacturing. Seen a little bit more evidence of that coming through.
Yeah, so we've seen equity markets softer over the last couple of days, and partly that could be due to Powell's comments last week about no need to hurry to cut rates, but also the ISM manufacturing survey, which, even though manufacturing is only about 10% of the US economy, it does have it's the most cyclical part of the economy.
Bit of a bellwether.
It's a bellwether, yeah. So it actually rose much more than expected to 50.3, up 2.5 points in March. Right. So back above that 50 reading.
So into growth territory.
Yeah, back into growth territory, and it's the highest since August 2022. And the details were quite strong. So prices paid was strong. I think employment was strong, new orders. So there was we have seen this manufacturing that had been incredibly weak after everyone had kind of bought all their goods during the pandemic, and then there was a lull and businesses destocked, and so manufacturing activity was pretty weak, and now we've seen it really sort of start to pick back up.
It's almost a bit of a normalization through that restocking period.
Yeah, so that's given people pause and thinking, oh, gee, the US economy's, manufacturing's expanding again. We're back in this sort of growth environment. So
good news is bad news.
Good news is bad news, and it's not just the US. So other manufacturing surveys, even in Europe, though they're still in negative territory, they were better than expected. And in China, positive for the first time in 7 months. So 50.9, up 1.8 points.
Right.
And the non-manufacturing one was the highest in a year. The manufacturing was the highest in a year as well.
Right, so back into expansionary territory.
Yeah, so back into expansionary territory. So as people are saying, despite everything that's going on in China's property market, really being, a bit of a handbrake on growth, maybe manufacturing and non-manufacturing services are pretty strong, and
maybe global demand helped pull them through this as well. Yeah,
global demand, but also, non-manufacturing is more domestic, and suggests that maybe the economy can grow at 5%, which is the government target. So people are suggesting maybe we've been a bit too cautious on China with these numbers that came out over the weekend.
Albeit probably happy to sit back and just observe that one for a little while. Yeah, we say good news is bad news because the good news economically means that there's less need for the central banks to cut rates soon. Therefore, markets generally get very excited about interest rates more than anything else, and that's why equities have probably cooled a little, not majorly, but global equities cooled a little in the last week or two.
Yeah, but they've had a very strong run
after
since
a stellar run
October, and so it's probably a bit more of a normal environment where higher rates, the 10-year bonds back up to 4.35, but equities haven't really been too bothered by it, albeit we've had a couple of days of softness,
but not majorly, and they probably have worn that sort of pickup in the long-term yields quite well, and that sort of dampening of rate cut expectations reasonably well. Albeit we saw a lot of return over a 3 to 6 month period, therefore we did really anticipate the later part of 2024 is going to probably be much more modest in terms of return expectations.
Yeah, well, markets have had a phenomenal run. I think we're up something like 14% year to date for global equities. So I don't really see a lot of continued gains of that sort of magnitude for the rest of the year. Particularly if the US economy remains strong and rate cut expectations continue to be dampened.
Yeah. And our expectation was always that even when we do get cuts, we were not heading back to anywhere like we were previously in those emergency zero levels, which had probably driven the speculation that we don't want to get back to. So probably a more realistic, normal long-term environment, and a healthy one where capital has a cost as well.
Absolutely.
Wonderful, Nick. An excellent summary as always. Thank you to you, and thank you to all our listeners. Take care. We'll speak again soon.